a bit of setting is required. Okay, here we go. Now, we are going to start officially with as far as the property, plant, and equipment is concerned. Basically, we are going to deal with as far as the total assets, sorry, or total accounting standards dealing with the non-current assets, basically, right? So, in the non-current assets, we'll be talking about the tangible, we'll be talking about the intangible, we'll be talking about the investment property as well, we'll be talking about the borrowing cost, the government grants. We'll be talking about the IFRS 5 as well, the non-current assets held for sale and the discontinued operation as well. But over here, we'll be focusing on the non-current assets held for sale because that is what it is related to as far as the non-current assets is concerned, right? So this is what I have in the mind. So we'll go through, go through these accounting standards, and obviously I'll be switching between the PowerPoint and the Word files, where I'll feel we have to add some more. We have to talk about some more. I mean, in detail related to a specific standard, something. We'll go into the details and then we'll have a discussion about that. Right. So, overall, again, I've as I already told you, property, plant, investment, intangible, and impairment of assets is over here as well. Yes, I forgot to mention the impairment of assets. So, this is going to be over here as well. So, we will try to cover up the maximum standards that we can over here. Okay. Now, IS 16 defines the property, plant, and equipment as the assets that are to be used on a continuing basis in the company's activities to provide access to the economic benefits. Now, they must be tangible. I mean, they should have a physical existence, else they would be classified as the intangibles, right? Now, the common examples for property, plant, and equipment include the land and building, machinery, vehicles, fixtures, and fittings, right? And then the asset, it should be initially measured at the cost, which should include the purchase price, including the import duties that we have. Okay. It's going to include the purchase price, including the import duties and the non-refundable purchase taxes that we have. And then where the asset has been constructed by the company, rather than being purchased, the cost should include the material and the employee cost that is directly related to the construction, that is the labor cost, basically, right? Then also, we are going to add into this cost directly, which is related to getting the asset ready for the use as well, including the architect, the legal fee, the site preparation, like for example, leveling the factory floor before the machinery is installed, and the installation and the testing cost as well, right? And in this, we also are supposed to add the initial dismantling cost, the removal and the site restoration costs in the cases where the entity incurs an obligation, plus the interest if capitalized according to IS 23. Now, when a company acquires an asset, it may find that it has an obligation to dismantle or restore the site once the asset reaches the end of its useful life. I mean, for example, a company that builds an oil rig in the sea may have an obligation to restore any damage to the seabed once it has finished the drilling, uh, you know for the oil. Now, the obligation must be recorded in the statement of financial position at the same time as the asset is being recognized, and the associated expense will be capitalized as a part of the cost of the rig's cost rather than being expensed. And this treatment will ensure that the ultimate restoration costs are matched to the associated income derived from the rig during the drilling process. So rather than straight away expensing it out, what do? We capitalize it into the cost of the non-current asset so that, at the end of the day, we are in line with as far as the accrual and the matching concept is concerned, because we are generating the revenue for now, right? So its cost should be charged, related to and it should be matched with the revenue that we have. Simple, right? And also, what we are supposed to, do over here is, as far as the borrowing cost is concerned, the IS 23, it permits the company to capitalize as a part of the cost of the asset any borrowing cost that is related to the acquisition or the construction of the asset, right? Now, as far as this borrowing cost and everything is concerned, we have gone into a very much of a detail, right? And maybe you must have find yourself that you are riding a roller coaster. I mean, as far as the coverage and the concept is concerned, na? So now let's just go to the Word file. Okay, let me just open up the Word file because I had to talk about and I had to create a ground where I was supposed to talk to you about now. So I have now the ground to talk to you about the basics of the standards which we have just covered. Now, I'll go over here in the Word file and I'll take you along with me, and then we'll have a discussion about this IS 16 property, plant, and equipment. Okay. Now let me just zoom it a bit because yes, it's more clear now. Now this deals with tangible, non-current assets, right? Now, tangible having a physical substance, right? Or a physical existence, and non-current assets means whose benefit was for more than 12 month. Okay, existence, here we go. Now, overall, IS 16 define property, plant, and equipment as asset held for production, for rental to others, words, for we can say administrative purposes. Now, asset held for production, your plant, your machinery, for rental to others. For example, you have a rent a car, bike, I mean, some sort of a setup or something. You are an outdoor caterer who holds or who organize the events or something, right? So you have the setup of the canopy along with the generators, along with the furniture and everything. So you just rent it out to the like for the events, right? So this is something that is like which you are using for the sake of the rental, now. So that's a setup that you rent out. It's going to be the property, plant, and equipment because every item is over there as a tangible, right? Similarly, you have a car, you have a bike, you have a house, you have a place, you have a plot or a piece of land that you rent out for a certain time period or something, right? So these things from which you are getting the or generating the rental income or something, these are going to be classified as your like a rental to others, right? So that's going to be over there as well. And then you have for supply of goods. For supply of goods, I mean, you can say you have the delivery vans, you have the forklifters, you have the trucks, or normally I call it as the assets on wheels. Anything assets on wheels you have, that's going to be over here. And then for administrative purposes, I take my all infrastructure over here, right? Okay. Then we have okay, right? So this is what we are going to have. Overall asset held for production, for rental to others, for supply of goods, for administrative purposes. This is what we are going to have over here. Then the initial measurement. As far as the initial measurement is concerned, remember initially all non-current assets at cost. Now, as far as the cost is concerned, the standardized understanding or the standardized definition that we have for the cost is that all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use, right? So that's going to be classified into as far as its cost is concerned, right? So the cost is all the expenses being incurred in bringing the item of non-current asset to its present location, condition, and expenses incurred so as to bring it to its intended use. That all the expenses that you have incurred in bringing the item of asset to the location, I mean, the delivery charges along with the buying cost, and then the condition if you get it installed or something, and then any expense that you have incurred so as to bring it to the intended use are gonna be over here. Like for example, we can have its list price being capitalized over here. In this list price we are going to exclude the trade discount, and we are going to exclude the refundable taxes. Similarly, we have the installation over here. Installation is going to be over here as well. Then we all know, as far as the delivery charges are concerned, we are going to have these over here. Then any legal fee that we have paid, it's going to be over here as well. We have the borrowing cost as well. That's borrowing cost is going to be over here as well. And then we have this cost of dismantling. This is gonna be over here as well. And this dismantling cost, let's just talk about this over here. Dismantling cost or future site restoration cost. Now, overall speaking, I mean, if we talk about as far as the dismantling cost and all is concerned, this is the present value of that dismantling cost has to be calculated and accounted for. Basically, what you do is you just simply calculate the present value in the current price terms, the cost that you will have to incur if you have to restore the site where you are using your plant or where you are extracting the natural resources. That in the current price terms, let's assume that if you have to wind up your operations or something, and then obviously related to those, if you have to incur your cost in leveling the site and restoring the site or something, then the current price term, what is the amount that you will have to incur as for clearing up and everything is concerned, right? So that is what we have to do over here. Now, we can say about this that same case that after 10 years the site will have to be restored, which will cost 100,000 in present value terms. Discount rate or required rate of return of the company is 10%. How will this be accounted for? Now, at inception, you are going to debit the asset with 100,000 and you will credit the future dismantling cost with 100,000. Now, at the end of the year one, at the end of the year one, the asset half is going to be depreciated. Asset will be depreciated over its useful life, right? That is 100,000 by 10 is 10,000 is the depreciation charge. And then this depreciation charge that we are going to have, we are basically applying the matching and the accrual concept over here, that on a yearly basis, we are just charging the relevant amount that we believe is related to the revenue or the related to the benefit that we have taken up. So we should charge the relevant cost related to that as well, right? So that this 10,000 is going to have the depreciation charge over there, right? And then the uh, liability will have the unwinding of discount effect as well. So present value into discount rate, this is what you are going to have over here into 10%. So that is 10,000 as well. So that is the unwinding discount. So you will debit the finance cost with 10,000 and you will credit the future dismantling cost at 10,000, right? So now if I go and I create my statement of comprehensive extract over here, statement of financial position extract over here. So we have a depreciation charge extra, that is 10,000, and then I have my finance cost in which I have my unwind discount, and this is going to be also deducted in the the statement of comprehensive income. And over here in the non-current liabilities, I will have my unwinding of discount, but rather not unwinding, I will have this future dismantling cost, and that is 100,000 plus 10,000, and that's gonna be 110,000 over here, right? So this is what we are going to have the, the future dismantling cost and all, right? Now, let's say after 10 years, the total of future dismantling cost is now standing at 1100,000. I'm just assuming, I'm not sure that it's going to be or not. I mean, with the 10% or something, but let's assume this is going to be the cost, right? At that time, when we are going to incur the expense and level the site or restore the site, the double entry will be debit future dismantling cost with 100,000 and credit cash 100,000. Nothing will go into the statement of comprehensive income as an expense or something because everything has been, charged over here, right? Okay, so this was the part over here where we talked about earlier as far as the dismantling cost is concerned. Okay, let's just adjust it a bit. I don't like it like this. I'll have it like this, the dismantling. This was the earlier over here. Now is the borrowing cost, and I'll put two static with the borrowing cost and the dismantling. I'll just keep it with the one. Right? Okay. Now moving ahead from here, let's just talk about IS 23 borrowing cost with the double static. Now, if you go with just 1 second, just one. Okay, let's assume now. So I was talking about this borrowing cost over here. Now, um, how to summarize the borrowing cost? Let's say if you are buying or constructing an asset, which will take substantial time to complete, and you have taken a loan to finance the acquisition or construction, then according to IAS 23, you are allowed to capitalize utilize the borrowing cost, right? Borrowing cost, BORROW. Borrowing cost is basically the interest cost, basically, like, the interest on loan that you are incurring now. So the standard says that if you are acquiring an asset, you are constructing an asset, and that asset is going to take some substantial time to complete or something. So during that time, the interest that you are paying, you are allowed to capitalize it up, right? This is the main story behind, this borrowing cost is concerned, right? This is the main long story cut short, that you are allowed to capitalize your interest cost. Simple, right? Now, this is as simple as it is, that you're allowed to capitalize the interest cost. But obviously, in order to capitalize, we have to, ensure that a certain criteria is being met, right? We have to ensure that a certain criteria is being met and certain rules are being followed as well, that are basically rules for capitalizing. Now, if we go for as far as capitalizing rules and everything is concerned, uh just 1 second. Okay, the rules for capitalizing are: the capitalizing will start once you have started to act to acquire or construct the asset. The capitalizing will start once you have started to act or acquire or you have started to act to acquire or construct the asset is concerned. For example, you got the loan and everything, but you are so much occupied and busy in the other tasks or something that you're not getting the time to plan out about as far as getting the task done is concerned, right? So you're gonna wait for that. You are going to wait for the time till you don't start hunting, you don't start going for the drawings or something, or getting the planning and everything is done for the construction is concerned, right? You don't start doing that, right? So the capitalizing is going to start from the day or the time when you will actively start working towards as far as the asset is concerned. And then the capitalization will stop once the asset is available for use, right? And the capitalization is going to stop when the asset is available for use. What does it mean? It means when the asset is ready and it's available for use, you are going to stop capitalizing the borrowing cost is concerned. Like, for example, in November, you completed the construction of your warehouse, but obviously the operations couldn't be shifted to the new warehouse, like what, the February next year or something, right? So the interest of December, January, February, it's not something that is which you are going to capitalize or something, right? You are not allowed to capitalize. The capitalization simply stops when the asset is available. If you are not using the asset or something, then it's up to you, right? I mean, it's up to you if you're not using or something. Now, although the asset is ready, right? So if you are not using it, it's your headache or something, right? I mean, the rule is simple. If the asset is available for use, you're gonna stop right over there, right? Now, after that, if you have invested some amount from the loan, then the net interest cost will be capitalized. Now, you got the loan, right? And for a certain time period, a certain chunk was not invested. You had surplus of the amount, so you just invested it, right? And you got some return, right? Now, the standard says that if the surplus amount is invested somewhere and you get the, like, the interest income or something, then the rule is from the interest cost, the interest income is going to be netted off and the net cost is going to be capitalized, okay? And then uh, you will continue to capitalize, you will continue to capitalize the interest cost during normal hold period or delayed period when the construction is stopped, right? Now, if the construction is stopped because of a normal delay or something, during that time, you will keep on continuing as far as the borrowing cost is concerned. Okay. Uh, in the construction process, when the beam is installed, right? The beam for the floor is installed. Normally, or the linter is installed, we can call it as the linter as well. When the linter is normally, we have to stop the construction for like around 10 days or something. I'm just giving an example to this. And we have to stop the construction because we means the engineers and all and everyone, they want the beam or the linter to be fully, dried. They want it to be fully dried. The concrete, it had to be fully dried before you start working onto that. Although you can walk right after 1 hour onto it, but technically speaking, as far as for resuming the construction is concerned, you have to wait. And the wait is over there because they have to ensure that it's properly dried and it's properly strong now so that you can resume your construction work onto that. Now, these 10 days for which you have to stop the work and everything, this is a normal, like, delay period. This is a normal part of the production and all, na? Or the part of the construction, right? So this is a normal delay or something, right? So if this is the case or something, or in some other construction or something, you have to wait for a certain time. These are the normal production process part. Na? So for these sort of things, if you have to stop, this is going to be or during this time period, whatever the interest is, you will keep on capitalizing it, right? But if the construction is stopped or activity is stopped due to some uncertain or uncontrollable event or due to abnormal circumstances, then the capitalization of borrowing cost will cease, right? Now, if the construction is stopped or activity is stopped due to some uncertain or uncontrollable event or something, right? Which is beyond your control or something, then during that time period, the capitalization of the borrowing cost will cease or it will stop. Like, for example, you are kind of 10-20% way through your construction when the owner of the neighboring property, he sued or he filed a case against you in the court because he believes that maybe you are damaging his neighboring his property or something, or you are doing damage to the neighboring property or something. Now, he has taken a stay from the court because of which your construction has stopped. Now, During this time period, till you don't get the result and you don't get the green signal from as far as like the court is concerned, till you don't get a green signal from the court is concerned, till that time you have to stop the construction. And obviously till that time when you have to stop the construction or something, obviously you will be bearing the interest cost and all during this time period. So technically speaking, during this time period, which is not the normal part of the construction or something, you are stopping your work and all. So this is something where you're not allowed to capitalize on interest costs and all, right? Okay, then if we move forward, let's just talk about as far as the you know borrowing cost is concerned, or the cost of borrowing is concerned. Now, same case, you took a loan at 9% to finance the construction or acquisition of an asset. So the cost is 9%. The cost of the loan is 9% over here, right? Now, same case, you had multiple borrowings, right? You had multiple borrowings, like for example, you had 8% loan notes for what? 168 million. You had 16% bank overdraft of what? 100 million. And then you had 12% debentures for what? Like 200 million, right? So the total is what? 168, 268, 468. So you have a total of 468 million, right? Now, out of this 460, you took 120 million. You took 120 million out of this general borrowing to finance the acquisition of asset, right? Now, the weighted average cost of borrowing rate will be applied, and that rate is gonna be loan notes 168 by 400 by 468, not 400, 468. Similarly, bank overdraft 100 by 468. Similarly, debentures 200 by 468. So if I solve this up, let me just get my calculator. Okay, so we have 168 by 468, sorry, 168 by 468. I get 36% over here, right? Similarly, I have 100 by 468. This is around about 21%. Then I have 200 by 468, and this is like around about 43% over here, right? So this is what? 36, 21, and 40, 100%, right? Now, this is what the weighted average I have now. So I'll calculate my weighted average over here. That is going to be what? This is the weighted average percentage will be. Now, if I, look over here, this is going to be 8%. First one is 8% into 36%, plus this is 16% into 21%, plus 12% into 43%, right? So my weighted average is going to be 0.36, then I have 0.16 into 0.21, then I have 0.12 into 0.43. So I have this 11.4%, right? So I have this 11.4% as the weighted average over here, right? So I have this my weighted average over here, right? So this is what I have over here. Now, let's just go back to the PDF because this is what we have been talking about now, right? So this is the whole explanation. If any one of you have any question, you can ask me. Otherwise, we are good to go. So anyone, any question? No question, anyone? Very good. Just 1 second, please. Okay, moving ahead from here. So we just talked about this IS-23 over here. Now, obviously, this is something which we have already talked about, the treatment for the finance cost, that we are going to recognize it immediately as an expense, or obviously, or we are going to capitalize it as a part of the cost of the asset. Capitalizing, it begins when the work to bring the asset into use has commenced, and we are not going to capitalize during the extended period, and we are going to cease the capitalization once the asset is available for use. Then the eligible interest relating to specific loans or the general borrowings using the weighted average cost. So this is something which we have just talked about as well. Okay, now the government grants IS-20. The government or the similar bodies may offer the financial support to the company to offer the assistance with as far as like subsidizing the general expenditure such as contributing to the employee cost to encourage a company to locate its operation in an area of high unemployment or unemployment, right? Or to support with the acquisition or the construction of an asset, right? So this is what we have. Now, IS-20, normally speaking, it requires that the grant income is matched to the related cost. However, it can only be recognized once there is a reasonable confidence that the company will meet the conditions, and hence the money will be received as well, right? So this is what basically we have for the government grant. Basically, if we talk about the grant, the IS-20, there are two types of the favors being given by the government. One is called as the government grant and one is called as the government assistance, right? The grant is something which is available to the specific class or specific industry or the specific area, whereas the assistance is something which is available to general public at large. For example, if the government is providing the subsidy on the petrol, then this is something you are getting, I am getting, everybody is getting. But if the government is providing a favor, a discount, a relief in the tax for the car manufacturers or for the energy sector or something, then this is something which is available to a specific sector. Na? So this is where it is going to be classified as a grant. Now, if you want to talk about the grant is available related to two aspects. One related to the expense, one is related to the asset, the expenses where the government is encouraging you to spend for the public or something, right? In terms of like, providing them with a job or something. And then if they are doing so, obviously the government is providing the favor and all into that context. Second one is where the government wants to promote a specific industry or something. Then for that, the government is like providing you with the help related to as far as the cost of the acquisition is concerned. So this is what we have overall speaking related to as far as the government grant is concerned. Now let me just take you back, and here we go. Now let's just go here. IS 20 government grant. Okay, let's have an example. Let's say you have assets cost 500,000, useful life is 5 years. Now the government grant is available on the asset for 300,000. The requirement: show how the grant will be shown and accounted for. Now we have option 1. Deduct the grant from the cost of the asset. This is option 1, where we are deducting the grant from the cost of the asset, right? Now, over here, what will happen? We are going to debit the asset with 500,000. We are going to credit the cash with 500,000. Then we got the grant, so we are going to debit the cash with 300,000, and we are going to credit the grant received or the grant income as 300,000, right? Then we are going to net these off. We are going to debit the grant with 300,000. We are going to credit the asset with 300,000. So revised value of the asset will be 500,000 minus 300,000, that is 200,000, right? Now, at the end of year 1, depreciation charge on the asset will be remaining value 200,000 by 5. We get 40,000, right? So extract of statement of comprehensive income. If we talk about, we have a depreciation charge over here. That's 40,000. And then if we have an asset over here, 200,000 minus 40,000, 160,000, right? So this is the option 1 that I have over here. Then option 2, record the grant separately and spread it over the life of the asset. Here we go. Over here in the second option, what do we have? Basically, we are recording the grant separately over here, like, over the life of the asset over here. Now, what's going to happen? We are going to debit the asset with 500,000. We are going to credit the cash with 500,000. Now, we are going to debit the cash with 300,000, and we are going to credit deferred grant with 300,000, right? So at the end of year one, depreciation charge on the grant will be 500 by 5 is what? 100,000. And okay. So depreciation charge on the grant will be 100,000, and over here we will have the recognition of grant income. Okay, this was supposed to be over here, and that is going to be 300,000 by 5. That's going to be with $60,000, right? Now, if I again go with the extractive statement of comprehensive income and then the extractive statement of financial position, I'll have my depreciation charge. That's going to be at 100,000. Over here, my asset is going to be at 400,000, right? And then I will have my grant income, which is going to be recorded at 60,000, right? And then in the non-current liabilities, I'll have my deferred grant. The deferred grant total was 300,000 minus, I have recorded 60,000 over here. So the balancing amount, 240,000 is going to be there. Now, look over here. At the end of the day, 100,000 is the expense, 60,000 is the income. Net effect, 40,000 is the cost that I'm, or the expense that I'm having over here, net effect now. And this 40,000 is exactly the same which I have over here as well, right? Earlier, when I netted off the grant from the asset now, so I charged the net depreciation of 40,000 over here. I mean, I can do this as well, or I can go and I can record separately as well. At the end of the day, whatever I do, the result the same over here, right? So this is what we have over here. Okay, now let's just go back and okay, so we are done with the grant over here. And then we have this illustration 305 year 5. So this is technically something which we have recorded over here. Now, moving ahead from here, as far as the subsequent expenditure is concerned, we are going to capitalize where enhances the economic benefit from the asset or the places that rapidly, depreciated component. And the repayment is that each class of asset is made either the cost model or the revaluation model. Okay. Now, the story. Any subsequent expenditure incurred in relation to the asset, it should be capitalized, obviously, where it can be shown that it is enhancing the economic benefit from the asset, perhaps by extending the asset's life, increasing the output or quality, or even reducing the operating costs as well, right? So by any way, we can have an enhancement of the assets benefit, or where the part of the asset or the component is replaced, perhaps as a part of the overhaul. The cost of replacement should be capitalized, and the carrying value of the component replaced should be removed from the statement of financial position, right? Because if you have replaced some component or something, obviously the older one, it has to be replaced by the newer one. So the old one, it will be de-recognized, and the new one, it will be capitalized over here, right? And then obviously, if we talk about as far as the rules of the IAS 16 are concerned, it allows the company to carry its non-current asset at the cost or revalue them to the fair value, obviously the subsequent measurement that we have, right? Now, obviously, the rule is simple that if one item of the property, plant, and equipment is revalued, then the other items in the same class must also be assessed as well, right? So the simple rule of thumb is that if you are revaluing one asset in a certain family or in a certain class, then all the assets of that particular family, they have to be applied or they have to be accounted for via the same particular model. Like if you are revaluing one, then you have to revalue the others as well. But if you are revaluing one class, it's not necessary to revalue the other classes as well. The rule is where one asset of a particular class is revalued, then all the assets of that particular class, they have to be revalued. The rule is this, okay? Done. Now, obviously, if we talk about as far as the revaluation is concerned, the revaluation, it must be kept up to date. But technically speak, I mean, having it up to date does not mean the standard has defined something that at what frequency, you should be doing the revaluation and all. Nah, it doesn't define the intervals and what, right? Some it simply requires the revaluation to be updated if the fair value differs materially from as far as the carrying value is concerned, right? Okay. Now, revaluation frequency with sufficient regularity to ensure that the carrying amount is not materially different, obviously. And depreciation is the each material component of an asset is depreciated separately and allocate the depreciable amount over its useful life over here. Right. And then apart from this, if we talk about as far as the disposal, removing the net book value and record the profit on disposal where the asset is carried at revaluation, transfer the revaluation reserve to the retained earnings. Now, the depreciation, I mean, it does not measure the change of the asset's value, but simply a method of allocating the cost of the asset to income statement according to its usage on a pro rata basis, right? Now, depreciation is a concept that, you know, we are already familiar with, our past papers, like from example, as far as the FR is concerned, we are already familiar with that, right? Now, overall, each material component of an asset must be depreciated separately. This is the component accounting concept, right? So some assets, they contain several components with very different useful lives. Like for example, if we talk about one of the complex assets, for example, the airplane, it has the exterior as the engines, the body, the interior, the cabin area. Similarly, for the cruise ship, they have the different propulsion system, the deck, the hull, the interior again. Similarly, the train having the engines, the bogies, the interior, the clippers, a big shopping mall, if we talk about, it has the complex assets with itself as well, right? So these are the complex assets. And so over there, each different component, it has to be depreciated over its individual life and all, right? So the depreciation must therefore be calculated on each of the individual components over their individual lives, like, having their individual residual values as well. Done? And then obviously, when the asset is going to be sold, it is removed from the statement of financial position, and the profit or loss arising on the disposal is taken to the income statement. Now, the standard, it doesn't allow the gain or disposal to be included in the revenue line of the income statement, right? But does not specify again where it should be classified. Now, this is interesting, right? The standard doesn't say, it doesn't allow you that you can take it to the revenue, but at the same time, it's silent at where it should be taken, right? I mean, as far as taking up to the gain is concerned, right? I mean, technically speaking, we normally make it the part of the other income, basically, because now over here, the standard from the revenue, it comes in and it guides us about as far as taking it up into as far as the recording is concerned, right? Now, on the disposal of the revalued asset, it must be remembered that the revaluation gain has already been recognized in the revaluation reserve. And so reserve transfer should be made from the revaluation reserve to the retained earnings, like, for the balance remaining relating to as far as the asset is concerned. Now, again, IS 16, remember this point. IS 16, it does not permit you the revaluation reserve to be recycled to statement for the year or something that you can take it up over there, as a gain or something, right? It does not allow you. It does not allow you to, like, take it up or something, right? So remember this thing, that if you have revaluation gain in the past and now you are disposing of that particular asset, then in that case, what you have to do is simply make a transfer from the revaluation reserve to the retained earnings. Okay. If this is the case or something, then simply do a transfer from the revaluation reserve to the retained earnings. This is what the approach you have to set over here. Done? So this is what we are going to have. Now, let me just take you back towards the Word file. And if we go back now, okay. So in the subsequent measurement, okay. Now, in the subsequent measurement, we have two models. One is called the cost model. One is called the fair value model. One is called the fair value model, right? Now, if we talk about the cost model, we have it that the asset is reported at its carrying value. Just give me a second, please. Okay, so the cost model is the asset is reported at its carrying value, right? And the carrying value is cost minus accumulated depreciation, right? And depreciation is wear and tear or decrease in the value of asset due to its usage only. right? Now, if we talk about the standardized definition of the depreciation, it is the systematic allocation of the cost of an asset to income statement according to its usage on a pro rata basis. It is the systematic allocation of the cost of an asset to income statement according to its usage on a pro rata basis. This is what we call as far as the depreciation is concerned, right? And then obviously we all are aware as far as the methods of calculating depreciation is concerned under IS 16. We have one as the uh, straight line method, and one is called as the reducing balance method, right? So these are the two methods that we have for as far as the calculating the depreciation is concerned. Now, overall speaking, let's say an asset's carrying value of an asset has a carrying value of 60,000, and in the current year it is being disposed of for 55,000, right? An asset has a carrying value of 60,000, and in the current year it's being disposed of for 55,000. So what's going to happen is we are going to have a cash of 55,000. We are going to, credit the asset with what? 60,000, and the difference, it's going to go into the statement of comprehensive income as 5,000 as a loss on disposal, right? So this is what we have over here. Done? Okay. Now let's just take a break of 5-7 minutes or so. We're gonna come back and then we'll resume with the second example, and then we'll move forward into it. Let's Okay, I'm back. So let's resume now. So we just had this example over here in which we had a carrying value of 60,000 and it was being disposed of 55,000, on which technically speaking we had a loss in disposal. And over here in this case, the loss is straight away taken to the income statement in full. Now, let's have another example. And over here, we have this thing over here that an asset carrying value is 60,000. Now, it is disposed of for 63,000, and then it also has a revaluation balance in the revaluation reserve of 12,000 over here, right? So if I go back in the revaluation reserve, okay. Now, if we have such a situation where the carrying value is like around at what, 60,000, and now it's disposed of for 63,000. Now what you're gonna do is we are going to debit the cash over here with 63,000. We'll credit the asset over here with what, the carrying value of 60,000, and then we'll credit the statement of comprehensive income with 3,000 as the profit on disposal. So, right? So profit on disposal is gonna be like what, 3,000 over here. Then with that, I mean, if we carry forward onto that, we have this revaluation reserve of 12,000. So we have to make its transfer to the retained earnings as well, right? So for the revaluation reserve transfer, the double entry is going to be revaluation reserve debit with 12,000 and credit retained earnings with 12,000, right? So this is what we have overall speaking for the part where we are having this, the transfer and all and everything is concerned, right? Now, moving ahead, let me just take you back. Where we were over here and into the PowerPoint. So let me just share. Okay, now we are now going to talk about this IFRS 5. Now, if we talk about as far as the IFRS 5 is concerned, that is the non-current asset held for sale and discontinued operations. Obviously, we are into the asset class, so we are going to talk about the assets for sale. Now, IFRS 5, it provides, special measurement and the classification rules for the assets that are held for sale, right? Now, an asset or a group of assets or a disposal group, it must meet all of the following conditions in order for it to be classified as held for sale. Now, the conditions, if we talk about, are that the asset or the assets are available for immediate sale, right? The asset or the asset sale, basically, if we talk about the sale, must be considered to be highly probable, which means that the senior management must be committed to the disposal plan and active program to find a buyer has begun and the asset is being marketed at a reasonable price and the completion of the sale is anticipated in next 12 months, right? So these are the points which all have to be met over here in order for you to classify the asset as held for sale. Obviously, the first point, that the asset is available for the immediate sale, it means that if the buyer comes, then obviously your asset should be ready enough that it can be transferred or it can be given away to the buyer. It's not that if the buyer comes and then you state that, sir, you have to wait, let us finish our production, or let us use it for our day, or we will be able to give you the next month or something. No, it shouldn't be the case. The asset, it should be readily available, right? And then the sale is considered to be highly probable, and the senior management is committed to the disposal plan. The senior management has decided and they have given their consent. They have given a green signal that, okay, fine, let's just find a buyer and look for the buyer. And as soon as we are done looking for the buyer, and as soon as, like, we get the buyer or something, we'll straight away dispose it off. Right. And then active program means that you have, told the agent to the buyer, or you have given the ad in the paper or some social media or looking to specific asset or something. So the advertisement or something sort of the stuff has been made, right? And then obviously this next point is really very important over here, that the asset is marketed at a reasonable price. Now this is important over here. I mean, the management is committed, you have given the ad, the asset is available, but you are asking way above than as compared to as far as the market value is concerned. Now this is a concerning thing, that no matter what you do, how committed you are, or whatever you do, at the end of the day, if the market is not, or the asset is not marketed properly or something, obviously you're not going to get the sale, right? So in order to have the sale, you have to ensure that it's going to be marketed at a reasonable price. And then the sale is anticipated to be there within the next 12 months. Now this is something, like, important as well, that you are expecting that you are going to get the sale in the next 12 months over here. Now, held for sale with the scrap, right? When you decide about scrapping the asset is concerned. Now there's a bit of a difference. I mean, the asset is going to be classified, or it's going to be called as abandoned rather than sold, like, if it doesn't meet the conditions, right? So if a company plans to scrap the asset or just stop using it, then the normal IS 16 rules are gonna apply. Okay, so remember this thing in the mind, that in order for, like, classifying the asset as held for sale or something, you have to have the asset in some sort of a working condition. If the asset is not in a working condition or something, then obviously it's something, like, which cannot be classified as held for sale. Then it's most probably gonna be classified as something, the scrap or scrapping of the asset is concerned, right? Now, overall speaking, when you classify, the asset that held for sale, the asset has to be measured at the lower of the carrying value or the fair value less cost to sell, which is the market value less any disposal costs that you have. Okay. Now, if you want to classify the asset as held for sale, what you have to do is you are going to report it at the lower of carrying value or the net disposal proceeds over here, right? So whatever is lower, you will report the asset on that value. Done. And then obviously, once the once you have gotten it, then over there, after this, the reassessment of the value has taken place. When you are done with this, no future depreciation on the asset has to be charged. Okay, so once you have classified it at the lower of the carrying value or the, the net disposal proceeds, you are not going to charge any more depreciation on the asset, right? And then again, the assets that are held for sale, they should be separately from the other assets in the statement of financial position or the balance sheet. Okay, top you have the non-current assets, then you have the current assets. Under the current assets, under you will write down the asset held for sale, right? And then you will have the total assets over there. Now, obviously, if it's a disposal group for sale, right, then in that case, the assets and liabilities within this group should be, separated and again shown separately from the other assets and liabilities in the statement of financial position. Done? Okay. And then, as far as the disclosures are concerned, obviously the additional disclosures are given in the notes to describe the asset held for sale, the circumstances of the sale, and the segment to which the asset belongs, right? So this is a straightforward, long story cut short, the point which is related to us is something that if we want to classify the asset held for sale, there are certain conditions which have to be met before we are set to classify it as held for sale. And then after those conditions, we have to measure the asset at the lower of the carrying value or the net disposal proceeds, and we cease to charge the depreciation. So these are the crucial points which you have to keep in your mind. Okay. Now, apart from the IFRS 5, the next one is the IAS 40, the investment property over here. IAS 40, investment property. It defines the investment property as land, building, land or building owned or leased under the right of use asset, or it's been leased out to earn rental income, or it's held by a company as an investment while its value increases, right? So, the investment property, this is something which is not going to be, or it cannot be any property which is held in the normal course of a business or in the normal activity of the business. Like, say in case if you are in the business of some as a real estate agent or something, right? Like, for example, the property of a house builder awaiting the sale will be accounted for as an inventory. It's not going to be accounted for as an investment property or something. Then, similarly, property being built for a third party, right? That's not going to come over here under the investment property. Similarly, the property occupied by the owner himself, that's going to be classified as the IS 16 over here. And the property awaiting disposal, that's going to be the IFRS 5 if it's under the, first it was under the owner's possession and then it's held for sale. That's going to be the IFRS 5. Then the property that is being constructed for the use as an investment property or something, until that property is not excuse me, until that property is not ready, that is something which is going to be classified as under the IAS 16 as well. So, I mean, if I wind up, by saying this discussion or by saying this point, that the investment property is a property that you have done an investment, right, in the form of the real estate or something, right? And if the investment is done into the real estate, then that is something which we can classify as an investment property. Done? Okay. Then, if we talk about the property leased to a group company point of view, now, where the investment property is leased to a parent or subsidiary, this does not qualify as an investment property in the consolidated accounts. I mean, in the individual accounts, it can be classified as an investment property, but from the group's point of view, it cannot be classified as an investment property, right? Now, if it cannot be classified as an investment property, then what to do? But again, what to do is something else. But the point comes why it cannot be classified as an investment property, because from the group's perspective, it's not an external investment, right? I mean, it can be treated as an investment property into the individual accounts, but from the group's point of view, this is something which we already have it with us. So it's not something like, externally we have or something, right? And then overall speaking, where the investment property is leased to a parent or subsidiary company, obviously this does not qualify, obviously, as we have talked about, that it's not going to be qualified as an investment property. Again, the reason is same, that it's for the group point of view, from the group point of view, it's not an investment, it's just a simple, like, the asset that you have, right? So in the individual accounts, you will like keep on classifying it as investment property, but from the group's point of view, you will record it under the rules of IAS 16 over here, right? And then overall speaking, if we talk about over here the initial measurement that is recorded at cost in line with the regular property, plant, and equipment, the subsequent measurement is the cost model using the IAS 16 rules, or the fair value must be disclosed over here as well for the cost model. Or then we have the fair value model with annually revalue gains or losses to the profit or loss, and we cannot depreciate it as well. Now, overall, the investment property, it should initially be recorded at cost in line with the rules of the IAS 16, right? And obviously, the cost is something that is going to include any directly related cost of acquiring the assets, such as the legal fee or the non-refundable taxes and all, right? So these are the ones which are going to be there, right? And then once recognized, the company can select one of the two policies. Like, either they can go for the cost, either they can go for the revaluation one or something, which must be applied across all of its investment properties over here, right? I mean, we have the cost model, we have the revaluation model as well, or we have the fair value model over here as well, right? Now, the cost model is where the asset will be depreciated over its, useful economic life, and carried at the net carrying value, or the not the net, but rather the carrying value here, with the fair value being simply disclosed, by a note or something, or the fair value model where each investment property is annually revalued to fair value, with the resulting gains or losses being recognized in the income statement, right? So the rule is simple. You can go for the simple cost model, right, where you are going to disclose the fair value as well, right? The simple cost model, when it's applied, the rules are going to be there over here, and the depreciation is going to be there as well. But obviously, the depreciation is never ever going to be charged under the fair value model. I mean, if you are using, or you're valuing your investment property according to the fair value, then you cannot charge any depreciation on the fair value whatsoever, right? Now, obviously, the investment property that is held under the right of use asset, right, we are going to measure it at the fair value as well, right? So this is something, if we have the property or the investment property in the right of use asset, then obviously we have only one option, and that is to value it at the fair value over here. Done. Okay, moving ahead from here, okay, moving ahead from here, let's just talk about, this is the intangible assets now, the ICE 38 with us. And if we talk about the intangible asset, an intangible asset is described as an identifiable non-monetary asset without physical substance. IS 38 therefore deals with the accounting of intangibles such as patents, trademarks, commercial software, database, non competition agreements. Yeah. And then we have the customer contacts, we have the customer relationships, we have the customer contracts with us, right? So these are all as far as the intangible assets are concerned, right? Now, it does not cover the intangibles that are addressed by their own accounting standards, such as the, lease, or such as, like, the goodwill itself, right? So these are the ones which they have their own the accounting standards related to these, right? So these are gonna be tackled over there, right? So overall speaking, if we talk about an intangible asset, it must only be recognized where it is identifiable. Identifiable means, it doesn't mean that you are able to identify the intangible asset or something. In accounting, identifiable means that it should have the capability of being separated, right? It should have the capability of being separated and sold independently of the business, right? This is what the identifiable means, right? I mean, again, the identifiable means that it should have it should be capable of being separated or divided from the entity and then sold, transferred, or even licensed, or even rented or exchanged, right? So this is the point. I mean, when it comes towards as far as the identifiable means is concerned. Like, for example, I mean, if I want to stress more about the identifiable, I can simply say that same case, uh, if we want to get some sportswear stuff, like, for example, I want to start jogging because I feel like maybe I've put on some extra, like, weight or something now, so I want to buy the best jogging shoes. So what is the first name that comes to your mind? The best jogging shoes or the best running shoes of which company should I buy, or of which brand should I buy? Obviously, when I ask this question, automatically you are going to have these names in your mind. Like, for example, I can buy from the Nike, I can buy from the Adidas as well, right? Now, the Nike or the Adidas, as soon as I say the name, right? Now, the Nike or the Adidas, as soon as I say the name, automatically their logos, their trademarks, right? They are straight away coming in our mind as well. That the tick logo for the Nike, the floral or the step logo for the Adidas or something. So these are straight away clicking in our mind that these brands have these such logos, right? Now, uh, if we talk about even these brands as well, these brands cannot record their logo, they cannot record their names within the financial statements as an asset. Why? Because these names, they were being, like, generated, or they got the growth or something as the business grew, right? So they have been there like this, right? So I mean, in the market, if you go and you want to buy some shoes or something, for the Nike, if you go, the running shoes are for, like, around what, somewhere around 10,000 or 12,000 Mauritian rupee or something, right? Now, if I take away the logo from the shoe of the Nike or the Adidas, will you be willing to spend 10, 12,000 on those? No, you will not be, right? You will be reluctant to, because you don't know what the quality of the shoe is going to be. I mean, obviously the Nike or the Adidas, they comes with the quality now. I mean, you already have a built up trust name of these brands if I talk about the, the comfort sleepers, the Adidas is number one. I mean, the best comfort sleepers that the any brand can come across or can have are of the Adidas. The best one they have, right? They come with the name of the comfort sleepers as well. Similarly, if I talk about the shoes, the Nikes are the best ones. I mean, when it comes towards the sportswear and all is concerned, but obviously, if I try to take away the name or something, I cannot rely on what the product is over there, because I'm buying them because of the name and all, because the trust, the build up trust that comes with the name, right? So these brands, they cannot record their own name as an intangible asset over there in their financial statements, because it's not separable from them. I mean, if we try to separate or something, that the whole existence of the business will cease. The whole business will cease to exist or something, nah? So we cannot do so, right? And then obviously, if it's not identifiable, obviously, the probable of having the future economic benefit of the cost is concerned, these points are automatically not met. So for an intangible to be recorded as an asset, 3 points: it has to be identifiable, future economic benefit is probable, and the cost is reliably measured as well, right? Now, initial measurement obviously is going to be at the cost, and in the subsequent measurement, either we can go for the cost or the revaluation model. Now, in reality, if we talk about, for as far as the intangible assets are concerned, the revaluation model is going to be rarely it's going to be used, as the standard requires the fair value be determined by reference to an active market, right? And given the unique characteristics of, as far as the intangibles are concerned, an active market will rarely exist. Okay. Given the uniqueness of the intangibles that we have, every company or every business has some unique intangibles and all is concerned. So technically speaking, saying that the active market is something which is going to be there or not, so it's difficult to say, right? So overall, if we talk about the sources of intangibles are concerned, mainly we have three sources with us for as far as the intangibles are concerned. Number one, firstly, those which are separately acquired, for example, the license, the trademarks, or the patents. Now, as these are externally acquired, so therefore there has been a transaction to acquire all these, right? And it is expected that the transaction is going to generate a future economic benefit as well. And if the transaction is going to generate a future economic benefit is concerned, therefore the probability recognition criteria that we have for that, it should be identifiable, the cost can be measured, the future economic benefit is there. So technically this probability criteria has been met. So yes, I mean, if it's satisfied or something, then we can say that yes, it is something, which we can record over here as an asset is concerned or as an intangible is concerned, right? And furthermore, because if we talk about with the externally acquired intangibles, we can simply say that there has been an actual purchase, and actual purchase has been made. The cost is over there, which can be easily be mired for these as well. Now, so we can go and we can record this up. And then secondly, the second source, if we talk about, this is where the intangible is acquired as a part of business combination. The acquirer may pay more than the sum of the fair value of the net assets of the acquiree to reflect, you know, not only the access it is gaining to the goodwill of the acquiree, but also the existence of the intangibles that are not reflected in the acquiree's own, the balance sheet or the statement of financial position, right? I mean, there can be a situation where, like, the parent company which is acquiring, it's paying way more than the goodwill and the other assets as well, the other net assets. So technically speaking, that is the extra which the company is paying, that is obviously for the intangibles, right? And obviously, this can be the case in the case of the customer list. It can be in the case of, like, the order backlogs that it has created along with the customer relationships that it has built or something, or the non-competition agreements that it has signed with some competitor or something. So these are the ones which are basically compelling that, I mean, we can go and we can pay some extra as well now, right? So these are the points which we have over here. So these intangibles that we have over here, now they must be recognized separately from the goodwill where the recognition criteria are met, right? Where the recognition criteria are met, they are to be recorded separately from the goodwill and everything. Now, IS 38 believes that the probability criteria are always satisfied, and there is a presumption that the fair value can normally be reliably measured, right? So this is what we have over here. And basically, the third source is internally generated intangible assets. Now, obviously, as far as internally generated goodwill is concerned, it must not be recognized as an asset because it's not identifiable, right? It's not separable from the entity, and the reliable measurement would not be probable, right? Now, for any other internally generated intangible, like for example, the research or the development, we have the rules and the criteria which we are going to follow. Now, if we talk about the research, research is basically a planned investigation so as to get a competitive advantage in the market, right? I mean, if we talk about the research, we can simply say, let's just go to the Word file for this because there are certain points which we have to talk about, and this is something which can be discussed in the paper as well. So let me just write up the bold points for you. For the IS 38, we have research and development over here. So research is planned investigation so as to get the competitive advantage in the market. As the outcome of the research, CAR's research is not clear, therefore, all expenses being incurred in the name of research are expensed out in income statement as and when incurred. But the tools, equipment, or infrastructure used for research are tangible, non-current assets. They should be capitalized and depreciated accordingly. Right? Okay. So we have this point over here that, you know, the research is a planned investigation so as to get a competitive advantage in the market. The output is not clear, outcome is not clear, therefore we cannot go and we can capitalize it up. But as far as the tools, equipment, infrastructure, and everything is concerned, these are the tangible non-current assets, right? So they should be capitalized and they should be depreciated accordingly. Simple rule of thumb, right? And then after the research, we have the development. Development is something bringing the research into reality. Bringing the research into reality is what we call as the development, right? And IS 38 allows to capitalize the development cost in line with accrual and matching concept to the future revenue that the development cost will eventually generate, provided a criteria in full is met. So the standard says, the I-38 says that you're allowed to capitalize the development cost if a certain criteria in full is met. If a certain criteria in full is met, then you are allowed to capitalize the development cost, right? And what is that criteria? That criteria is called as sector. That is a separate project, expenditure identifiable and measured reliably. Then we have commercially viable, technically feasible, overall profitable, and resources available to complete. Right? So this is what we have for the criteria. That is the sector. We need to have a separate project. It should not be a part of some existing project or something. It should not be the extension of some existing project. It should be purely a new separate project. Then expenditure identifiable and measured reliably. You should be able to, identify that what expense has been incurred, what amount has been spent and all in order to capitalize it up. Because technically speaking, if you don't know that what amount you have spent or something, then what are you going to capitalize, by the way? Right? I mean, if you don't know what you have spent or something, then what are you going to capitalize, by the way? Commercially viable. Commercially viable means that, this uh, the whole arrangement, what you are doing at the end of the day for, this, the product that you're making, eventually, commercially, this will be able to exist, this will be able to be sold or something, and it's going to be commercially possible as far as for your product and everything is concerned. Then technically feasible is your project or the product that you are developing. Technically speaking, it will going to work. There will be no technical flaws or something, and you will be successful. Overall profitable means the cost that you're spending in order to, get your uh, product done or something, you will be able to recover it up, and then you will be able to generate the profit and all is concerned as well, right? And then you have this overall profitable means that, this is the overall profitable that you are going to get the profit, and then the resources available to complete. It means that you have enough manpower, you have enough financial resources and all to complete as far as your product and everything is concerned, right? So this is what we have overall speaking related to this one, this technical feasibility, intention to sell, use, ability to sell, use, and all, na? So this is what we have. And then the generation of economic benefit and everything is there. Then the intangible assets with a finite life, they are going to be amortized over their useful life. Once the development is complete and you start the commercial production, from that time you start to, you know, amortize the development cost, right? And it's normally amortized over useful life. And then obviously, if you have the intangibles with the indefinite life or something, then obviously do not amortize them, and you simply go for the impairment testing and all, right? And then you simply go for the impairment. Now, this impairment thingy will start, this impairment and everything will start from the next week, right? Let's just stop it over here. Let's just stop it over here. This impairment, the whole thing will start from the next week. Let's just stop over here. So the multiple standards which we have covered so far, these are more than enough for now. Now, what you have to do is just go through this again. I am going to, upload everything onto the Academy 2. So you can have these slides from there, and the Word file which I've created, that's going to be there as well. So while, like, revising, you have this with you, so that when you sit and you revise, you are at least sure that what you have to do and how you have to do, right? So this is all from my side. I mean, meanwhile, if you guys have any question or something, you can ask me. Otherwise, we are done for the day. Yes, any question, anyone? None of you? Okay. Okay. So I guess this is all gonna be for now. Okay. So I'm gonna see you next week, same time, same place, same channel. Till then, you have to take care of yourself, your family, your friends, and the people around you. I'm gonna see you next week. Till then, bye bye.